Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:09 a.m. Central Time, and I am recording this in preparation for the market day of February the 12th, 2015. So let's dive into the overnight action. And what do we have? We have broad market indices all up pretty nicely, really, at least in general, about 0.5% across each of the four broad market indices. The Russell being the most bullish, and the other three all being pretty much in the same place relative terms. Obviously, we had some big news come out from the Ukraine situation last night that seems to have buoyed markets all the way around. Crude oil up also 1/4%. The euro up about 0.37. Gold up about 3.1. Bonds took probably the biggest hit and the biggest move, and it was down about 0.75%. In overseas action, all the key overseas futures or regular index markets we watch are up. China, Hong Kong, Japan up the most, 1.85%, and Germany up 1.54%, and then of course the FTSE and the United Kingdom up 0.11 for probably the most modest response. In terms of macroeconomic reports, today is Thursday, so we do have the usual slate of Thursday reports: unemployment claims, core retail sales, you have a natural gas, and if you're a bond trader, also look out for that 30-year bond auction. In terms of tomorrow's action in the United States, we've got import prices for an orange flag report, and then the University of Michigan consumer sentiment, and that one comes out during the trading day, so always you have to be careful of those that pop out during your trading day. So not an unusual week by any means. All the usual players for Thursday and Friday. In terms of volatility, where are we on our current volatility? Well, yesterday was, I believe, dojis on 3 of the 4 broad market indices, and as such, you're not going to have an awful lot of increase in volatility with that kind of price action. And as we take a look at our short-term volatility, VXST did drop to 14.28. You also see our current implied IV percentiles also dropped. These were running about midpoint yesterday. Now they're all decidedly below the midpoint, with the exception of the Dow, which is still a little heavy. Nothing in terms of standard deviation moves yesterday in any of the 4 broad market indices, so things have been really very quiet in recent trading days. If you look at the last 5 trading days, there's 1, 2, 3, 4, 5 out of 20 possible standard deviation moves, and that's pretty tame, really. Probably norm is about 2 a week, so we should see probably a little bit more in terms of intraday range than we have seen in this last week. So things have definitely calmed down, and perhaps maybe starting to get a little too quiet and kind of coiling up for something more important to happen. So always kind of keep that in mind as you move from one extreme of volatility to the other extreme of volatility. You always have that return to the mean. In terms of our daily report, this is very much the same as yesterday. We continue to see kind of more normalization coming into play. We think we are probably in market trend intermediate term phase opinion of a phase 3. So we're looking for higher highs and higher lows. Portfolio trader posture is confirmed uptrend now, and our active trader market posture is bullish across all 4 indices. Position sizing opinions from both measures are up to 100%. You do have a neutral market timing opinion outlook for the 1 day, the 3 day, as well as into the 2 week where we go to slightly bullish. I mentioned a moment ago the market forecast opinion, the market posture is bullish, and indeed all 4 indices are showing very nice ratings, very nice curves, and really call for all okay and normal conditions for new short-term or intermediate-term bullish trades. You have on our hedge risk opinion a 0 plus. I continue to kind of fight between the what do I see, and that's been all of my indicators going to normal settings, versus what do I feel. And I feel like we're still pretty much in the range. You know, yesterday was the first day that the SPX had a close. Actually, 2 days ago was the first day that the SPX had a close outside of the 2015 range. And yet, what do we follow that by? You know, you look for confirmation. We follow it by a doji. So I continue to feel my gut that we're still in a range, and we've just kind of tickled one side of the range and not really have followed that through with any kind of confirmation, and certainly no momentum, energy, or volume. So that's why I continue to show something of an elevated level, 0 plus. We still have an awful lot of distribution days. On the S&P, we now have a count of 6, and NASDAQ 5. Our VIX phase we're calling neutral, but we note that it's been flipping back and forth. And indeed, so much of this, we've got moving average lines and other indicators that are really all flat, and they flip back and forth and give signals that seem to mean something. Well, as those of you who are technical analysis fans, you know that those MACDs, those stochastics, those moving average lines, when they're flat and wrapped around each other, that's when they're the least meaningful, and we're seeing that across many of the other indicators. You know, no matter what kind of indicator, when you have flat lines, they're not as powerful as they are when you're in a trend and you see a rollover or a roll up. In our intermarket risk aversion indicators, we're 5-0 risk on, everything acceptable there. Option income strategies is a go. In fact, I put on a couple of them myself recently. But VIX is actually now the second day back inside the acceptable window, but still remember, it has also been flipping back and forth. In terms of our sector-specific market posture, very, very green, looking good everywhere except for the utilities. And utilities has flip-flop in essence with energy. Energy has become much stronger of late, and utilities much, much weaker. In fact, I saw one report yesterday that this fall-off on utilities may be one of the biggest fall-offs in terms of just how sharp a drop utilities has experienced in some 90 years. So bottom line is utilities has had a very significant fall off. Hopefully you protected your positions in terms of protecting profits with some sort of profit management system like we use here at Falcon Global, to be able to protect those profits as positions rotate. And we may very well be seeing sector rotation going on right now. We continue to watch this very closely in our room, but there's a lot of indications that we may be experiencing some sector rotation across a number of former heroes to zeros, and kind of changing places of late. And indeed, we take a look at yesterday's percent change by sector. We do see a couple of our normal consumer staples, healthcare, but these aren't huge numbers. Remember, we had Doji Day yesterday. Consumer staples is the most healthy response. Information technology has been one of the recent rising stars potentially, so continue to watch that sector. And you see energy took a hit yesterday. As we said in the overnight action, energy seems to be up somewhat this morning. Look at utilities though. Utilities down 2.39%, continuing to take hits. So kind of a little bit of the old end a little bit of the new being shown here, where you have like consumer staples and healthcare being relatively healthier, but at the same time we have both energy and utilities as our two dogs of the day yesterday. In terms of industry group specifics, retail is back to top dog. Railroads, transportation, internet, healthcare follow that up. Seen some increasing talk about chemicals, so might start to take a look at that sector or that industry group. And then biotech has been really pretty active of late as well. So if we go a little bit further down, we'll start to see some other interesting industry group subsectors starting to percolate. So that's your top industry groups. As always, we greatly appreciate your following us on Facebook and our other social media platforms. Facebook is probably the best place to put commentary, or to, of course, send in an email or comment or question, whatever, to support@falconglobaltraders.com. As always, please like us on YouTube where you're following us. We have our own YouTube channel, of course, if you found that. More information, of course, available at falconglobaltraders.com. Disclaimers, as always, we are an educational group. Hit the pause if you need more time for that. And then, of course, we always thank you for your contributions and participation with the Falcon Global Traders community. Thank you, good trading, and goodbye.